Welcome to my discussion, the topic of investments. Today's subcategory will be investments that have significant influence. I have a goal today, and the goal is to learn the accounting for investments with significant influence using the equity method of accounting. In our last pencast, we looked at significant influence, assuming that the book value of assets and the fair value of assets were pretty much the same thing. In this example, we're going to assume that the fair market value of the assets of the company that we invest in are greater than their book value. So I write greater, that's so cute, are greater than their book value. And you'll see that that changes things a little bit. Let's get some facts going. So, let's assume we purchased 25% of the outstanding stock of Cool Company. That's 100,000 shares we purchase at $3 a share. So, we're going to pay $300,000 for our investment in Cool Company. Although we are not purchasing 100% of Coal Company, we are purchasing 25%, and let's assume that significant influence does exist. Well, since we're actually outright buying a company, we're going to do the accounting for this company as though we actually own it. I'd like to look at the assets that we bought, the book value and the market value of each one. Let's assume the book value of our inventory is $30,000, equipment $50,000, the building $100,000, liabilities $400,000, and if you net those, the net assets are $680,000. And that is what is reflected on the books of Coal Company on the day we purchase it. What are the market values of those related assets that just today we're purchasing? I've listed the market value of them, and you can see the inventory has increased by $10,000. The market value is greater than it's on their books for. The equipment has also increased $10,000, the difference. The building's worth $200,000 more than is on their books for, and liabilities are the same. Well, how much did we pay for this? Before I calculate our percentage ownership, or before I calculate goodwill, I want to drop to our percentage ownership. So we purchase 25% of this company. So in a sense, we're purchasing 25% of their net fair market value of assets. 900,000 times 25% is $225,000. So that is the fair market value of our investment in Coal Company. Well, as you'll recall, we paid $300,000 because we bought 100,000 shares of stock at $3 a share. So there's some implicit goodwill in this transaction in the amount of $75,000. So that's our portion of the goodwill of Coal Company. When you do the equity method of accounting, you don't record all of their assets like we would if we outright bought them. Nor do we actually record the goodwill we just calculated. And under an equity method, we do what's called one-line consolidations. And that is, we allow them one line on our balance sheet, and that line will be the investment account balance line, and everything that affects it will be recorded in that. We give them one line on our income statement. That will be investment revenue. But that's all the airtime that they get on our financial statements. I want to do a little bit of more information here for you. Let's assume that cool company, I like saying that, their net income for the first year we own them is $500,000. And let's assume that they paid a dividend in full to all their shareholders in the amount of $20,000. And remember, we're a 25% owner, so if you follow this through, we're going to say 25% of that income is ours. We're also going to assume we got 25% of the dividends. So in what we've learned prior to this point in accounting for equity investments is that we would have a $300,000 balance in the investment account, that we would have increased it for their share of the income because we own 25% of it, and that we would have decreased the investment account for our share of the dividends. And we would be through if we had purchased this company and book value and market value were the same. But in our example, market value is greater than book value, and we're going to need to make some adjustments for the differences that we calculated. So I brought forward the amounts of book value and fair value and the difference, and what 25% of that difference would be. Recall that inventory was 30, but really worth 40. Difference is 10. Our percent of that's 2,500. And the equipment, 50 versus 60, so 10,000. Our percentage of that's 2,500. And the same for the building, with our percentage being 50,000. If this company would have had fair value on their books when this transaction happened, these assets would have been a different amount. The inventory when sold would have been 10,000 more, of which 2,500 would have been our share. So cost of goods sold is run. Equipment would have been shown at fair value, which states the depreciation expense would have been different in net income, and the same for the building. So what we need to do is to correct net income for our share of those differences. We need a few more facts. Let's assume that 100% of the inventory was sold in the current year. All that inventory is gone and new inventory is on the books. Equipment that they had on their books had 5 years left with no salvage, and the building's 30-year life left. No salvage, going to fall right down at the end of 30 years. We need to fix the net income of $300,000 that we said was our share by these amounts. So what would that be? So we said the inventory was 100% sold. So cost of goods sold would be wrong by $2,500. We need to increase cost of goods sold by $2,500, which will drop inventory. The equipment, well, it had a 5-year life and no salvage. 50,000. Oops, wrong number. 2,500. The difference, our difference, right here, would have been depreciated over 5 years, no salvage. 2,500 divided by 5 would be 500 per year. So the equipment has the incorrect depreciation amount in the amount of $500 because we'd be writing it off over 5 years. All of the inventory is gone, and 1/5 of the depreciation for the equipment. Let's move to the building. The building is undervalued by $50,000. Divide that by 30 because it has a 30-year life. That suggests the depreciation expense is $1,667 too little on the building. So we have some corrections to their net income in these amounts. In a sense, we're saying that had they used the greater fair value amounts, these expenses would have been different by this amount. What is the total the difference of expenses would be? Go ahead and total that. We're saying net income was $4,667, too much, some of which was cost of goods sold and some of which was depreciation. So, let's make the entries for this investment and see where we are. Let's start at the beginning. First, we purchased the investment. If you recall, when we purchased it, we paid $300,000 for it, so we would write investment in cool for debit $300,000, and then we would pay cash. And of course the investment was in common stock, and we can influence what they do by voting our 25% investment in cool in any particular way. Then cool over the year had net income, and if you'll recall, their net income was, I don't recall. What was their net income? $500,000. Of the net income, 25% is ours, so we need to pick that up. Why 25%? We own 25%. Under the equity method of accounting, we're going to increase our investment account in cool by 25% and call all of that investment revenue. $125,000 into the investment account, picked up as revenue. Now, you'll recall, coal paid dividends. When coal paid dividends, the amount of the dividend, we said, was going to be in total $20,000, of which 25% related to us. So 25% of $20,000 is we would have got cash in the amount of $5,000. And that is looked at as though it's a return of investment to us. So we're going to decrease our investment in cool company by the amount of the dividends. So true to the method of accounting for the equity method, we record the purchase at cost. Net income is put into our investment account at our ownership, and dividends get taken out. But net income is overstated by $4,667, so we need to fix that. So we need to revise net income for the difference in fair market versus book values. This is a one-line consolidation. We're not going to call it cost of goods sold and depreciation expense. We're just going to pick up the entire amount. And here's the entry. It's going to be debit investment revenue for $4,667 and credit our investment in cool, because we overstated revenue, by $4,667. Now, net income is what it would have been if we would have outright purchased at fair market value 25% of coal. Where does that leave us in our investment account? What will show up on the balance sheet is what's in this account. We get one line. We'll post our original purchase price into the investment account. I also want to see what's happening in investment income, our one line on the income statement. When we picked up coal's net income, we increased our investment account by $125,000, our 25% of their net income, and we picked up investment revenue by $125,000, our share of their income. So here's our purchase, and here's our share of their net income, and you can see it's in investment revenue. Then, when they paid us a dividend, we decreased our investment account by that as a return of capital, so to speak. And I picked up that. Now my correcting entry, where I revised net income to be what it would have been had those assets been recorded at fair market value. income would go down by $4,667, and so would our investment, because we need to correct the amount of income. So there's our revision, our adjustment, taking the related accounts from book value to fair market value. What is the balance in the investment account and the balance in investment revenue? We would show on our balance sheet the investment account at $415,333, and that would be on our balance sheet a one-line consolidation. And on our income statement, we would show investment revenue of $120,333. The $4,667 adjustment lost its character. It's not cost of goods sold and depreciation. It's just all buried in that one line on the income statement. So our income for gold investment would be $120,333. I don't know what it is about this method of accounting that I think is really cool. But I do. I really do. I've always liked it. Thanks for joining me, and we'll see you soon.